Hello, folks. Dan Bird here with ORAT Nation. Mr. Zuber is with his family for Easter. Happy Easter, everyone. Hope everyone's having a great Sunday. Not sure if anyone's going to watch this, but I'm going to just do an update for the week. And I'm going to do a second video regarding trading psychology, which is really important. It's actually going to be part 3 of my Technical Analysis 101 sessions, but this is probably the most important part. But that's session number 2. So let's get started today. I'm going to go ahead and share my screen and we'll jump into it. For those that are interested, my newsletter is free. It's right on my website, breakpointtrading.net. And you can just click on this button right here and get the newsletter. The market is still doing great. I mean, it's still going up. Doesn't really look like any reason to start to come down again. I'll look at a few things that are kind of subtle, something that we might want to pay attention to. Nothing dire at this point, but I'm going to show you an article too that we'll spend some time on. But if you click on this button here to go to the newsletter, it will take you directly in. And the top part, there's some cartoons for those that like a quick laugh. So last week, here's the economic calendar for last week. The big one to me is this GDP number. GDP came in much stronger than expected. Not much, but definitely stronger than expected. So the economy is still strong, still moving along pretty well. Durable goods orders were up as well. So all of that is great for the economy. PCE, which came in on Friday when the market was closed, that's the key one that the Fed looks at, and I'm going to show you a couple of things related to that in a minute. The week after next is the CPI report. Next week, I'll spend some time on CPI, and we'll look at what previous one looked like and what I think might happen. It might be a catalyst for the market, so the week after next. But PCE came in pretty much even as expected, a little bit lower than last month, still slightly high, but pretty much as expected from last month. So next week is the most important one. Next week is the jobs number. And I'll show you some things on that. Non-farm payrolls expected to come in at 198. We'll see. That one has had a tendency to exceed expectations in the first round. And then the next couple of months, it gets revised downward significantly, which I think is really interesting. I'm not saying that it's being manipulated. I'm just saying that it's interesting during an election year that the payroll number seems to come in really high, higher than expected. And then over the next couple of months, it continues to be revised downward, although the media or the politicians don't say anything about that, of course. The big one, though, to watch is the unemployment rate. 3.9% is what it was last month. It ticked higher, 2% higher, 0.2% higher last month. Forecast to come in even. We'll see. Might come in a little bit higher than that, but I'll show you some things about that as well. Actually, it's right here. So this is the SOM rule. Make this a little bigger. The SOM rule basically says that recessions happen when the 3-month moving average, which is the red line right here, rises up by more than half a point above the 12-month, which is the green line. So I've got arrows where this has happened in the past and the recessions that followed. It just started right now, but it's not that 0.5 yet. So right now it's at the 12-month is at 3.68. In order for it to be 0.5 higher, it has to be at 4.18, which is this level right here. But you can see the rate of change is ticking higher. So this is going to be a really important one to watch next Friday to see what that unemployment rate comes in at. If it's 3.9, as they're forecasting, since this is a moving average line, this will tick up slightly. So this will start to move a little bit higher. The 12-month will move a little bit higher. And this target that we're shooting for will also move up a little bit. So we'll see what happens. Of course, if it goes much higher, then that's really going to affect it significantly. And you can see what happens typically with unemployment. When it starts to tick higher, then it accelerates very quickly after that into the recession. So we'll see. That's one thing to watch as far as the recessions go. This is something that I want to talk about also. This is a article that a friend sent me saying that, when the Fed starts cutting rates, then we get a recession, which I've been saying that for months. It's one of the three recession watches. The second one is that unemployment rate that I just showed you. But he said his comment was there's a really good image of the results the last time the Fed cut. And my comment was what happened in 95 and 98? The Fed cut those years too. Of course, that doesn't fit the author's narrative, right? So here's the image that he pointed to. And of course, it looks dire, right? First cut, percent decline, 24, 55, 42, 45%. But hopefully for those folks that have been watching me for a while, probably know what I'm going to say next. And I hope that you will look at this, a chart like this, and as quickly as possible, pick out which of those years were secular bull markets and which ones were secular bear markets. You can actually pick them out pretty quickly. Now, everybody knows the 2020 recession was COVID, right? So that one went down pretty significantly, but it was only a 2-month recession. But look at the other two that were really light, 9.2%, 7.1%. Those are secular bulls. So I redid the chart and I said, this is the way you should have shown it. Secular bulls and secular bears. So COVID was during a secular bull. So yeah, it did decline quite a bit, but it was very short. So only 2 months for the COVID recession. And the other two that were in secular bull markets were that 9.2 and 7.1. Everything else, sorry, with these big numbers are secular bear markets. So always keep that in mind when you see articles like that. It's very important. This bullish percent index we're going to look at in a second. This is actually was chart that was sent to me by a subscriber saying, I've seen this on another site. Can you duplicate it? And I actually duplicated it almost exactly the way that he sent it to me. And it's now included on my website. I added in the overbought and oversold areas. And I also added in the moving average lines on the NDX, just to give you a sense for what those look like. But I encourage anyone to send me articles like this and send me charts like this. If you want me to add them to the website, I'd be happy to do that. So it's much appreciated. Let me jump over again over here and we'll go to the charts section. And I want to show you a couple of charts real quick before I get to Stock Traders Almanac and what they're talking about. So first, let's take a look at the S&P 3-year chart. Very strong. I mean, it's continuing to go up. It's following this is an 8-day moving average, following that up very nicely. All of the indicators are moving up. This is overbought, but it can stay overbought for quite a while. So I wouldn't necessarily use these kind of things to say, it's time to sell because it's overbought. It can stay overbought. And never use one indicator by itself anyway, ever. So everything looks really good. If we look at the NASDAQ, same year, 3-year, NASDAQ looks good too. It's sort of stalling out a little bit right here. So the NASDAQ in particular and large caps especially seem like they're stalling a little bit. The momentum starting to cross over, maybe rolling over. So we'll see what happens. Let's look at the Russell because small caps and medium caps are starting to break out. And you can see the sideways channel that it's been in for, ever since 2022. And in October, when the whole market started to go higher, it went higher as well. It broke out of that channel, came back down, hit the 21-day, and this is a weekly chart, by the way, so each one of these bars represents a week. But now it's really starting to head higher. So we'll look at that as well, look at a relative chart on that one. Also, let's look at the McClellan oscillator for the NASDAQ. McClellan oscillator basically shows a moving average of the advanced decline line for the NASDAQ. So what that means is these are advancers versus decliners. So if the market is moving down like it was from July to October, then you would expect there to be more decliners, which there were. But as the market hit lower lows, there were fewer and fewer decliners. during that period, meaning that this was coming to an end. But look what's happening right now. The market's hitting highs. It's kind of leveled off. This is the NASDAQ again. So it's not hitting new highs anymore. It's kind of leveled off. It's actually, in the last 2 weeks, it's actually declining. And the advanced decline line is having a really hard time staying above that zero line. In fact, it's been below it more often as the market has gone higher, which is the opposite of what happened over here. So it's actually fewer and fewer advancers are participating in this market advance. And I included the bullish percent index, which is the chart I just showed you that a subscriber sent me, but I've already had it here. In fact, he said, do you have this on your website anywhere? And it is. This is where I think it's the most appropriate for it to be. The bullish percent index shows the percentage of bullish stocks in the market right now. And you can see how that has declined significantly. So that's continuing to go lower. The last thing I want to show right here is the weekly trend analysis. So this just puts together a few trend charts. If we look at the S&P first, you can see down below it's short-term, medium-term, and long-term. So long-term, very bullish ever since beginning of the year, really, basically March timeframe. Medium-term, bullish, then it went bearish, then it went back bullish. Short-term has been bullish, but less and less so. And it's just getting close to that zero line. But let me point out the money flow index here. And in fact, let me try something because I just updated this, but let me refresh the screen. We'll look at it again. So the weekly trend analysis for the S&P, now it's a little bit more clear. So the money flow index is on a 4-week and a 1-week basis. The 4-week is the blue one, so that's the longer term. The 1-week is the gray one, so that gives you a much shorter term view of money flow, whether money is flowing into or out of the market. And that's the one that turns usually before the longer term one. Look what it looks like right now. Even as the longer term continues to go higher, it has rolled over and it's heading towards zero. Now this is the S&P. Let's take a look at the NASDAQ. NASDAQ is even more apparent. That one is right at the zero line. So if that continues to go down, it's just one more. Again, I said these would be subtle. These are very subtle indicators. There's just things to watch. The NASDAQ also down here on the short term trend has gone below zero a couple of times, even though this other one, they both should confirm each other. This one hasn't quite got there yet. So we'll see if that one drops below zero. But this is the one that concerns me a little bit is the money flow. It looks like money flow is starting to flow out, especially for the NASDAQ. Again, doesn't mean there's going to be a crash. Doesn't even mean there might, the market might decline significantly. It just means it's getting a little tired, kind of running out of steam. On that topic, we'll look at the growth versus value chart. And again, I pointed this out a couple of weeks ago. Growth versus value is running in a channel, but ever since February, value is outperforming growth. So when this line is moving up, generally moving up, that means growth is outperforming value. When it starts to move down, that means value is outperforming growth. And you can see the momentum indicators are getting ready to cross over as well. There's the Qs and the large cap. So that, again, it's subtle. It's still barely above this long-term trend line. But if it drops below that, and we'll see next week what happens. If it drops below that, then that might mean there's rotation going on and maybe Wall Street is starting to get a little defensive. If we look at the mid cap, this is Russell IWM versus the Qs. As I said, small caps, the Russell is starting to move higher, starting to outperform the NASDAQ, the large caps. And that's what this is showing. It's actually about to break out or just did break out of this level. It still needs to get through this level up here, though. But you can see the Qs and the IWM. But look at the large cap, mid cap, and small caps. Large cap especially is definitely rolling over. Mid cap, it seems to be following the large cap, and small cap, even though it's showing relative strength versus the large caps, it's rolling over a little bit as well. So even though that there is some rotation into small caps, the overall market, again, looks like it's starting to roll over a bit. So just out of curiosity, we'll look at the Magnificent Seven versus the Russell 2000 versus small caps. And again, since this is moving lower, it just turned red right here. So if it's red, that means the Russell is outperforming the Magnificent Seven. So all of these are indicating that small caps are going to outperform the large caps, and money is rotating out of those large cap technology stocks. All right, so last thing I want to do here before I go over and take a look at Stock Traders Almanac, a really interesting article that they put out, is I want to talk about the market timing strategy that I've showed in the past. It actually gave a go to cash signal. So we went to cash on the 19th, and it's been sitting there even though the market has actually gone higher. So the signal to go to cash was a VectorVest confirmed down signal, which happened on the 18th. So the next day we went to cash. Now it's moved back up. So you might be saying, well, maybe that was too early. And maybe it is. If we look at the long-term view, it's still in a bullish configuration. So there's the VectorVest down signal right there. But if we look at the shorter term, medium term, again, it hasn't been able to break out of that previous high right there. So this blue line is the go to cash point. It's still above that, but it's starting to come back a little bit. Momentum is waning in both of these sections right here. So we'll see what happens. But that brings me to another email that was sent to me by a subscriber or someone watching the YouTube channel saying that, have you ever done a back test of the 2000 and 2008 time periods to see how this strategy might have performed during those periods? Now, remember, those are bearish, very bearish markets. And there is a bearish strategy down here, which is the QID. That is a double leveraged bearish ETF, which means if the market's going down, it will go up. So in a bearish strategy, we would rotate out of the QLD, which is bullish, and into the QID. So I was really curious with that question to see what actually would have happened. So I put together this chart, make it a little bit bigger. And this, now that one of the issues, of course, I ran into is that it didn't have QID or QLD at that time. They didn't exist back then. So what I basically did was it took the triple Qs, which is what that ETF represents, and I calculated it based on the triple Qs, and I just doubled the gain because that's a 2x. So here's the down signal, VectorVest confirmed down right there. This is in 2000. So March of 2000, that was the VectorVest confirmed down. That's our signal to go to cash, which is the one that we just got a couple of weeks ago. The signal to go, the confirmation to go into the bearish ETF didn't happen until over here, until September. So from March until September, about 6 months, we were in cash, not doing anything, waiting for a confirming signal. Now, the confirming signal here is when the MACD crosses over here, the colors change, so the 40 and the 50 moving average, those change right here, and we get a red bar on that day. When those things happen, that's when we go into the QID. We want to get really good confirmation before actually using this 2X ETF. So that's where the entry signal came in. And then it did not get a move to cash signal until this changed back to green, and these MACD, these momentum signals went back above, went bullish again. So that's the go to cash signal right there. The result is a 96% gain. So nearly double the money using a double leveraged bearish ETF. So you doubled your money even though the market went down during this period. So what happened in 2006? Well, here's what it looks like for 2006. VectorVest gave a confirmed down right there in October of 2007. So that was a signal to go to cash. Signal to go to the QID did not happen until right over here in December, actually the last day of December, with a red bar that went below the moving averages, and the momentum, the MACD down below, moved below. So it crossed over, the gray one crossed over the green one. So that was a signal to go to QID. The signal to move back to cash was when this MACD crossed back above, and we got a green bar right here. We actually had a number of green bars. So theoretically, you might have even entered earlier as long as you keep really tight stops. But we got a green bar right there, so that was the signal to go to cash. But look, it still took 1, 2, 3, almost 3.5 months from that move to cash before we got a confirmation of a bullish signal here in July of 2009. Now March was the low right there. Again, you could have entered earlier, could have entered on the first green bar, or you could have entered when it first went above this moving average line, or when it went above the 50-day moving average line right there. Any one of those, as long as you keep tight stops, because there's not really confirmation yet that the overall trend has changed. It's just giving you indications that it might be in the process of changing. So it's okay to enter early as long as you keep tight stops. And the recommendation is about 5% on the stops. So in this case, 98% gain through this period, a little more than a year and 3 months roughly. 98%, so again, doubling the money during this period, during a down market, doubling the money. So that was the result. It was a really interesting question. I really encourage folks to send me questions like that if you have anything, and I'd be happy to put things like this together to show it. So that's that I think was a fascinating study. So let's now move over to, this will be the last thing I do here. And this is the Stock Traders Almanac, which I think was a really interesting article. So I'm going to take a little bit of time going through this. So what he's saying is money begins the last month of the best 6 months, which is normally November to April. Okay, so money starts April. It's had more than double the historic average during these last 5 months. Their best 6 months seasonal MACD signal, sell signal, can trigger anytime on or after the first trading day of April, which is on Monday. All right. So keep that in mind. Also keep in mind, he's saying we are not issuing the signal at this time. We are only preparing you for when it does arrive. So the worst 6 months are going to be starting here soon, but we don't really know when. I showed you some subtle indications that the market might be running out of steam. So kind of put this in context of the things that I showed you before. All right. This is the MACD down here. It's kind of gone flat, even as the market has moved higher. Again, just looking like it's running out of steam. Now, during Q1, this Q1 was the third best Q1 in history. It ended at 10.2%. He actually shows it down here. Q1 today with a gain of 10.2%. All right, that puts it right in here as the third best Q1 in history, or at least back to 1950. So that's pretty good. And you can see what's happened usually, other than 1987, which in Q4 we had the flash crash in 87. But the full year still ended up 2%. But most of these years that where we're participating have been up significantly by the end of the year. How does this compare with election years? So a great election year starts. This is in 3 categories. The first category are the best Q1s. The next one are the average Q1s, and the last one are the worst Q1s. So again, this is the third best Q1. And during election years, again, for the full year, the market ends up. Last 6 months, the other two that were ahead of us, up 4.6, 1.3, but some of the other ones are significant gains as well. So that looks pretty good. How does it look for election years right here? Where are we right now? So the red line is the top Q1 for election years. That's basically what I just showed up here. And this just puts it in a chart. So that's what it looks like for Q1 election years, the red one. The green one is when a sitting president is running. And we are right here. So we have outperformed, even though we've basically followed right along with that top Q1. We actually outperformed it the last couple of weeks. But in April, starting in April, it starts to decline and kind of move sideways. So this decline is roughly about 3%. So, that might be what happens. Doesn't mean it will happen. Just showing you some historical data, but something just to keep in mind as we move into April. And then I think that's it. That's what I wanted to show you here. But really interesting article. For those that subscribe to Stock Traders Almanac, I encourage you to go out and read it. I'm going to put this information in next week's newsletter because I just read it yesterday. So really interesting stuff. I think it basically is telling us that we have a really good shot of having a great year, but we may have a little bit of chop starting here very soon. Don't know when, but starting soon. We might have some chop going sideways. And then again into the election, and then after the election, the market takes off again. So this data goes back to 1949. All right, so that's where we are. Again, if you're interested in subscribing, just go to breakpointtrading.net. The free newsletter is there. You don't need to subscribe to anything to get that. If you do want to subscribe, down at the bottom, you can register your email, and you'll get a reminder that the newsletter is available, or you can get access to everything for $99 a year or $15 a month if you want access to everything else that I'm showing you here. All right, thanks a lot. Have a happy Easter. I'm going to do a second session today regarding trader psychology, really important topic. So stay tuned for that. Thanks, everyone.